Good afternoon. Welcome to the Center for Responsible Lending's webinar, The Consumer Financial Protection Agency, How the New Agency Will Protect Consumers from Predatory Lending with Ellen Harnick, our Senior Policy Counsel. The Center for Responsible Lending is a nonprofit, nonpartisan research and policy organization dedicated to protecting home ownership and family wealth by working to eliminate abusive financial practices. CRL is affiliated with Self-Help, one of the nation's largest community development financial institutions. For more information about CRL and about the proposed agency, please go to www.responsiblelending.org after the call. At the end of the call, Ellen will take questions submitted via the chat function at the bottom of the video. And now, without further ado, Ellen Harnick.
Good afternoon, everyone, and thank you so much for being with us today as we talk about the Consumer Financial Protection Agency. I think the first question we should answer is, why do we need a Consumer Financial Protection Agency? And the simple answer to that question is, we currently have no one whose primary mission it is to protect consumers with respect to financial services and financial products. This is somewhat extraordinary. We have agencies that protect American consumers when they buy food, pharmaceuticals, toys, automobiles. The American economy depends upon the confidence that people rightly have in American consumer products. That consumer financial products should be the exception is particularly extraordinary when you consider the significant role that the financial services sector plays in our economy. And it is even more extraordinary when you consider how very important consumer spending is to our GDP. The problem is not merely a theoretical one. Because of the lack of consumer protection, we've seen products dominate the market that include payday loans for which consumers pay 400% per year or more. We've seen credit card fees that double even on existing balances. We've seen borrowers and homeowners who are steered into subprime mortgage loans that are more expensive and more explosive than the more stable loans they qualify for. These are the real consequences of not having an agency whose job it is to protect consumers from abuse. And the very unfortunate fact, some of us would say the tragic fact, is that so many of these products are forced upon people who most need the extra money to spend on health care, on food for their children, on clothing, on basic consumer goods. And the consequence of this is not merely the diminution in the standard of living of these many families, but it impacts the economy as a whole, because as consumer spending capacity is diverted to pay off 400% payday loans, for example, that spending is therefore not directed toward buying the kinds of consumer goods that would bolster jobs in manufacturing and in sales. So why do we need a Consumer Financial Products Protection Agency? We need it because we can no longer afford to leave consumers unprotected in this area of the economy. The next question I think it's fair for you to ask and for me to answer is, what's wrong with the existing agencies? For heaven's sakes, we have federal agencies who have among their many missions the obligation to protect consumers. Why haven't they done their jobs? Well, this is a very important question, and I think we have to answer it carefully because it really explains why we need the Consumer Financial Protection Agency. The existing agencies, have they failed because they're staffed by bad people? Have we fallen victim to industrial sabotage? No. People who work in agencies, just like people who work in businesses, respond to the incentives they're given and to the disincentives they're given. That is how all of us behave. And so people who work in the regulatory agencies that exist today are governed really by the way those agencies are structured. And the way those agencies are structured, consumer protection gets very, very, very little priority. So why is it? I'm going to go over this briefly, and I'll be very happy to ask questions from people who want more detail. But fundamentally, there are 4 weaknesses in the existing structure which, if not fixed, will leave us vulnerable to exactly the same catastrophic consequences we currently face. The first of the 4 main problems is the simple fact that banks get to choose the agency that's going to supervise them. So regulators who are eager to have as many banks as possible under their control. This is important because the more banks an agency regulates, the more power and influence the agency has, and the bigger its budget. So how would you as an agency go about attracting banks to come and let you choose them as their regulator? Would you do that by saying, we are going to be really rigorous on consumer protection. We're going to hold your feet to the fire and make sure you do the right thing by your customers? No. It turns out that banks prefer to be supervised by agencies that are laxer on consumer protection. And so we had a situation in which the agencies who had, among their many obligations, the obligation to protect consumers, found that it was better for them to provide limited consumer protections. And as a quick example, Countrywide Financial, which is a company that all of us have heard of, which has had such an enormous role in financially devastating millions of families across this country, they actually changed regulators midstream and became a thrift, which is a type of lending institution, because they perceived that the Office of Thrift Supervision would be even weaker than their current regulator when it came to consumer protection. And of course, the Office of Thrift Supervision provides competition to, for example, the Office of the Comptroller of the Currency. So they now need to weaken their consumer protection because they don't want to keep losing banks to the Office of Thrift Supervision. So you get the point. If banks can choose among several regulators, consumers will lose. That's the first problem. But that's not the only problem. We had the Federal Reserve, which had the power to protect consumers, I should say the power and the responsibility, the obligation, to protect consumers from unfair and deceptive acts and practices. They were authorized to cover the whole market, so they weren't subject to this sort of regulator choosing. And in fact, belatedly, in 2008, they issued some regulations that would rein in some of the excesses that have cost millions of families their homes. Why didn't they do it sooner? Why didn't they do it in 2006, in 2005, in 2004? Was it because no one knew that there were abuses in the market in 2004? Is it because consumer protection experts weren't warning the Federal Reserve Board and the other regulators that we had a crisis coming, that abuses were rampant? No. In fact, people who were expert and focused on consumer protection were making this very point. And the problem at the Federal Reserve Board was that the Federal Reserve is not only responsible for consumer protection. They are responsible for our entire monetary supply, among other things. They're busy people. They're focused on other things. And more importantly, or as importantly, the people who are in charge of the Federal Reserve Board historically were much more focused on the perspective of the banker, the perspective of the macroeconomy, the people with real consumer protection expertise who were aware of what was happening and what were needed, did not get the priority focus at the Federal Reserve. That is the second problem, and the second reason why we need an agency focused on consumer protection. The third problem is you need to have not just strong rule-making capacity in a regulator motivated to protect consumers, you need strong enforcement authority. You need someone who can make the rules and make sure that people who break the rules are brought into the line before catastrophe happens. And lastly, the fourth problem is that some companies, some financing companies who call themselves, for example, mortgage banks, but weren't actually banks, they didn't have any federal agency supervising them. So the fourth reason why we need a consumer financial protection agency is we need an agency that's motivated to protect consumers that has the ability to cover all consumer products without regard to the kind of company that issues them. This is what's been wrong with the system to date, and this is what needs to change. So what would change if we had a Consumer Financial Protection Agency? First of all, we'd have an agency that would make consumer protection a real priority, a real priority. It would be the sole focus of this agency. The agency could develop real expertise, institutional expertise in the kinds of consumer abuses that arise and the best way to counteract them. We need a vibrant and innovative agency that can focus on consumer protection. That's one thing that would change. The second thing that would change is this agency would cover everyone with respect to consumer protections. Every bank, it could organize, whether the bank is organized as a thrift, as a national bank, as a state bank, as a non-bank mortgage lender. It wouldn't matter what charter the company chose, this agency could cover and would cover all of them. Thirdly, the agency would write the rules and it would enforce them. Lastly, the agency would have the authority to stay on top of abuses so that problems could be identified and addressed before we reached national or global catastrophe. That is what the Consumer Financial Protection Agency would really do. So how likely is it that we're going to end up with a vibrant and effective Consumer Financial Protection Agency? The answer to that question, and the reason for this call, is that the answer really depends on all of you who are listening today. And I want to pause and stress that. It depends on all of you. Right now, we have an industry that is organized and passionate about defeating this agency. And they are visiting members of Congress and senators every day, one by one, in a steady drumbeat of argument about why we have no need for a Consumer Financial Protection Agency. We can let the existing agencies protect consumers. We shouldn't separate consumer protection from other aspects of financial regulation. And this steady drumbeat will continue unless it is met by a steady drumbeat of counterargument from people who you know and who you represent. Ordinary people need to visit their representatives, need to call and write their representatives, their members of Congress, their senators, and let them know we care about this. This is not an esoteric, theoretical issue that we don't care about. Our standard of living, our livelihoods depend on this, and we are very interested in seeing it happen. So what do we need from you? What we need is for you to reach out to your constituents, to your neighbors, to the people who you know and care about, and ask them, urge them to make their voices heard. We have a wonderful opportunity right now while Congress is in recess. Members of Congress and the Senate are home in their communities. This is a great time to contact them through their district offices. Go and schedule a visit with some of your neighbors. Make clear we need an agency, a single agency, whose priority is to protect consumers. I think I'm going to pause now. I'm going to take questions and answers. If people have specific questions, I'll be very happy to respond. The one thought that I'd like to leave you with today, this is one of those moments in history where things have the potential to change fundamentally and to improve fundamentally. It's sometimes hard to get energized about this because the structure of regulatory agencies sounds so disconnected to the quality of our lives, but it is not the case. And so if you walk away with anything today, know this is an opportunity. It will not arise again for decades, and we can do it right. So with that, I'd like to first of all remind you that you can visit our website, check back frequently because we will update the documents we provide to address new questions that come up. We have myths and facts to address counterarguments that we hear being made. we are at www.responsiblelending.org. With that, I look forward to your questions.
Ellen, there's a question of which agencies were the biggest offenders in terms of failing to look out for consumers?
Well, I suppose I would say that none of the agencies has distinguished itself in really adequately protecting consumers. The Office of Thrift Supervision, of course, had oversight of Countrywide and others of the really worst offenders in the subprime mortgage space.
Okay. This person says, I don't have any experience communicating with a member of Congress. What should I say?
Okay, that's an excellent question. I appreciate whoever asked it. I think you call or write to your member of Congress, and in your letter you say that you are very concerned about abuses in the financial services sector, and you urge your member to support the establishment of a strong, separate agency solely focused on consumer protection for financial services and products.
Another question is, will a new agency really make a difference? Doesn't it really depend on the people?
Well, that's another excellent question. So, of course, an agency is only as good as the people who work there, and the people who work there are only as good as the system that's been set up and the extent to which they're held accountable. And so once we have this agency, if you bring that about, it will be all of our jobs to urge our members of Congress to hold the agency accountable. But the difference that this agency will make, a separate agency, is that it will have as its sole job, its sole reason for being, protecting consumers. I should pause for one moment here. When we talk about the Office of Thrift Supervision and the Office of the Control of the Currency, we should remember that their primary job is what we call the safety and soundness of these banks. Safety and soundness is sometimes described with the words prudential supervision. But basically, this is the job of making sure the banks don't collapse. And that often is viewed as equivalent to bank profits. And so the problem with existing agencies is they were being asked to look after consumers at the same time they were asked to look after bank profits. And as we know, consumer abuses in the near term, before the whole thing comes crashing down, in the near term can sometimes be quite profitable. So this agency would not have to be distracted by other concerns and would be able to really focus in a smart way on what's needed to protect consumers. Obviously, protecting consumers ultimately is essential to the safety and soundness of these institutions, as we, the taxpayers who've been called to bail them out, have so painfully discovered.
There's a question about the preemption and whether attorney generals will be able to enforce consumer protection laws. What about a private right of action?
Okay, those are very good questions. I should say now that in the bill that the administration proposed, and also in the bill that Chairman Barney Frank, the chairman of the House Financial Services Committee, that he introduced, which is very, very similar to the administration bill, these do not give the agency the authority to create new private rights of action, meaning new grounds upon which individuals can sue. That's something that many consumer advocates think is a disappointment. But nevertheless, the key thing is that this agency would have the authority to enforce the laws and get redress for consumers. As for the states, what is really essential about both bills, the administration and the House bill, is that they respect the traditional role of the states and preserve the ability of the states to protect consumers within their borders. This is something that many industry actors object to, but it is a fundamental piece of our democracy. And it has worked effectively for all these years, and yes, that would be preserved.
Cora from NACA would like to know how the CFPA will be funded.
Well, the funding, as it's written into the bill, will be a combination of essentially an advance of fees, advance of a budget through the appropriations process, but then there'll be a combination of fees and assessments, and I think that's still to be determined by the agency how best to accomplish that.
How likely is it that the final legislation will include CRA jurisdiction, oversight and enforcement for the agency? How do we make sure that happens?
Well, all I can say about that is that the administration's bill did include CRA, which is the Community Reinvestment Act. However, the House bill did not include it. And I can't really handicap what the likely outcome of that is. But I do note that there's obviously a difference of opinion between the administration and House Financial Services on that aspect.
We're told by some legislators that they want to separate rulemaking from enforcement in order to pass the bill and give enforcement to existing regulators. How do you respond to that?
Well, I think the concern that we here at CRL have had is that rules need to be enforced, and especially if we're looking not to private rights of action. And even if you have a private right of action, it's expensive for individuals to sue. Individuals have a hard time enforcing their rights, particularly when the people who have been injured are least likely to have the resources available to protect their rights. So it is, to my mind, essential that the agency have the power to enforce the rules it writes.
So there are a couple of questions about small banks, community banks, and whether CFPA will hurt them.
Okay, that is an important question because that's an issue that's been raised a lot. I should note, and I've seen this in some media articles and in a website that's been set up, that there actually are some community banks that are public in their support of the Consumer Financial Protection Agency. The way both bills are set up and the way we envision it, ultimately they should benefit responsible lenders, and community banks, we should note, have in general not been the culprits in the subprime mortgage lending fiasco. And in fact, they often found themselves unfairly competing with companies like AmeriQuest, who could run these enormous ad campaigns on television and otherwise, pushing what looked like better products, but were in fact more expensive and worse products than the very, very simple, straightforward, honest products that these community banks were offering. So I think there is some misconception, and also I think lenders in general, like all industry actors, have initial reaction, which is fear that if there's more regulation, they'll be disadvantaged. I think in practice, the community bankers will do quite well. I should say the other issue that some of you may hear if you talk about this is that if we have a separate agency supervising on consumer protection, this will raise the cost to these community banks because now they'll have one regulator looking after safety and soundness and another regulator looking after consumer protection. And we should be clear, the bill is very, very clear that the agency is required to coordinate with the other agencies to make sure that this supervision happens in a seamless and efficient way. And there's ample precedent for that. It goes on here and now. We at CRL are affiliated with the Self-Help Credit Union, which is examined both by the North Carolina Banking Commission and the FDIC, and the two agencies coordinate, and it's very easy and expected that it'll be done in a way that does not unduly burden the institutions.
Can you talk more about the relationship with the states, and won't this agency just create more work for the states?
Well, it should. That should definitely not be the case. No, the states will have the room to do what they've been doing, but the agency itself is going to make and enforce its rules. And so the idea of more work for the states should not be a problem.
Will this raise costs for responsible consumers?
What should end up happening is that this will reduce costs and increase consumer choice. And I want to pause on this because when industry is, and I shouldn't speak of industry as a whole, because as I've said, many responsible lenders, or some responsible lenders, have stepped out in support of the agency. So I'm putting aside the responsible lenders who see this as a good thing. The lenders who are nervous about being subject to consumer protection have made a bunch of arguments to try to instill fear in consumers and in policymakers. And the two things they say are, this will raise costs, this will decrease consumer choice. And I have two responses that I think are worth noting. First, these arguments have been made by these same lenders throughout the entire crisis. And in fact, when I mentioned earlier that the Federal Reserve eventually passed some regulations that would have averted needless loss of millions of homes had the regulations been passed a couple years earlier, when they were suggested, the same arguments by industry were made. No, don't do it. You'll raise costs and you'll decrease consumer choice. So that's one point. Keep it in perspective. The second point is we should know that the absence of regulation has actually raised costs. This is something of a misconception, I think, that's been out there. Even in the subprime space, where we know subprime loans are more expensive than prime loans. That's why people prefer prime loans. But even in the subprime space, people were pushed into loans that were more expensive than the other loans they qualified for, and they just were never offered them because no law required the brokers and the lenders to offer them, and brokers and lenders made more money by charging higher rates. So the cost of not having adequate protection has been extremely high for all consumers. And I guess the last point I would make, we've now seen an absolute catastrophe that is grounded, of course, in these foreclosures, which are grounded in these abusive loans that did not need to have been made so abusively. And the consequence of this is a loss of wealth for all of us. It has been very expensive for all of us to have had inadequate consumer protection for so long.
This person asked for a cite to the bills that you've mentioned.
So the administration's bill can be found on the administration website, and I'm sorry I don't have a source for it now, but we can put up on our website a link if it's not there. The House bill is, the bill number is H.R. 3126, and if it's not in a link on our website, we'll help you get to it, but you can also go to www.thomas.gov, and if you put in the bill number, you'll be able to get the legislation, and you'll see who sponsored it already, which may be very helpful. In fact, that's worth checking.
This person says, we'd like to expose the degree to which banks are aggressively lobbying to defeat the new agency. Is CRL compiling information on banks lobbying that we might use locally?
Well, that's a very good question. I don't know if we are. I will look into it.
Okay. And how much will this cost taxpayers?
How much will the agency cost taxpayers? Mm-hmm. Well, the way it works currently, the existing agencies get fees and assessments from the banks that they regulate. And so as the consumer protection responsibilities of those agencies will be moved away from those agencies and consolidated in this one agency, some of the costs that the existing agencies used to incur will no longer be incurred. And so some of the fees and assessments from the existing agencies can now be used to pay for the costs of the current agency. I think the other costs will be, I think we talked about how there'll be different ways that the agencies can raise the money. I don't actually know what the final cost is, but it will be minimal in comparison to the cost of having no agency. I should make one other point here, perhaps. I think there may be some perception that having another agency means expanding the regulatory reach and that there's going to be more regulatory activity, which one would expect to be expensive. In fact, it's the opposite. Currently, we have 7 different agencies enforcing 17 different statutes in different ways, sometimes with overlapping jurisdiction, and so there's a lot of inefficiency. All of that now would be brought into one agency. And so the other thing that the taxpayers will get the benefit of is a streamlining of the regulatory work. And so there should be some cost effectiveness there. But I can't stress enough, the cost of inadequate consumer protection is staggeringly high.
So we just have a few more questions. And one is, this new agency needs to be able to enforce the rules it writes, right?
Absolutely. I think it needs to be able to enforce the rules. I think it needs to be able to get access to the institutions the way the Office of the Controller of the Currency and the OTS currently do. They need to get access to what these institutions are doing before problems become widespread. And yes, certainly, they need to be able to enforce the rules to bring bad actors in line before the problem is catastrophic.
You mentioned a few times that various regulators and a number of different agencies are responsible for consumer protection. How bad is it and how many agencies are involved?
Well, so currently, I think I was saying there are roughly 7 agencies who have different roles, and it is pretty dispersed, and when you have a situation where nobody really takes ownership of this, the situation just is not good.
The last question is, what do you think the odds are of this passing?
Well, it's hard to handicap this. I guess I would say the real success of this depends entirely on all of us. We really can make it happen. If we put our energy and our passion into it, it will happen, and your children will get the benefit of it, your grandchildren will get the benefit of it, and all of us will enjoy a better economic life. So thank you so much for joining us, and please follow on our website, and I look forward to working with you to get this bill passed.